Welcome to Search for Yields, the weekly newsletter from INR Bonds. I'm Arjun Patsati, and in this week's newsletter, I'm going to talk to you about how SEBI is removing 20 years of corporate bond market lethargy through bond platforms. Corporate bond market has been widely discussed for the last 20 years by government, by policymakers, RBI, SEBI, and all the industrial bodies because of the fact that India has been lagging behind in the corporate bond market in terms of development. And corporate bonds is seen as one of the fastest drivers of economic growth in the world. So, in all, various data proves that the developed world, including China, is way ahead of India in the development of corporate bond market. And to a very large extent, because of the lethargy in corporate bonds, the retail investors have been denied access to this market. And this has also been preventing the growth of the corporate bond market. But before I take this further, what is Search for Yields? Search for Yields is a weekly newsletter from INR Bonds. And as you all know, INR Bonds is a digital bond platform which is going to be one of in the forefront of taking the corporate bond market forward in India, enabling retail investors to access the market and help widen and deepen the corporate bond market. And SEBI is definitely one of the catalysts through the new regulations. I'll talk to you about the regulations. Investors have now a very good option and to invest, and Search for Yields gives investors all the necessary information and knowledge that is required to invest in corporate bonds. And INR Bonds, again, apart from providing a digital bond platform for buying and selling corporate bonds, is also one of the leading players in research and training in fixed income on an online platform. We have been there for around 10 years doing exactly how educating investors and providing the best research on fixed income markets for investors to take the best investment decisions. Now, coming back to SEBI's regulations on corporate bonds. Now, SEBI has invited the public to send comments on a draft circular on corporate bond on regulation of bond platforms. So, what SEBI has acknowledged that given that platform, if you take equity markets, the last 6 years, the equity markets have grown substantially in terms of investor participation. And this has also helped, this is also seen in the number of depository accounts opened with NSDL and CDSL. And this is largely through the bond platform, through the equity platforms, like platforms like Zerodha, Upstocks, Grow, and others have really encouraged the investors into open account easily and start trading in and investing in stocks. And clearly, all other asset classes are on the platform, are trading through platforms. And globally, the experience is that corporate bond platforms are growing substantially and very fast in comparison to the rest of the other players in the market. So clearly, a platform for corporate bonds is the best way to encourage investors to invest more in corporate bonds, access the bond market directly, provide liquidity to the market, and even more important, enable issuers to access the market from borrowing. And this is the most important catalyst for economic growth in the country, which is recognized by the government and all the policymakers and globally itself, including World Bank, IMF, etc., and all other central banks and governments, to acknowledge that a good corporate bond in India, market in India, can take it very fast to one of the top growing economies on a sustained basis in the world. India is way ahead in terms of government bond market. One of the earliest adopters of electronic trading in government bonds, largely because of the RBI that has really thrust the electronic platform forward. And 95% plus of volumes in government bond market is through electronic bond platform for GSECs. And RBI has taken the first initiative to open a retail electronic bond market platform for retail investors to invest in GSECs. Very simple. All an investor needs to do is open an account with the RBI, a retail direct platform. And they're ready to go to invest in government bonds, which is the most safest of the instruments. And corporate bond platforms, again, will be the next catalyst, like RBI has thrust the GSEC market ahead through electronic bond, through the GSEC bond platform. Corporate bond platforms will be the catalyst for the growth in corporate bond market in India. SEBI has given four regulations to be considered. One is that all the bond platforms take an broking license from BSE or NSE, and which is good because then it comes directly under SEBI regulations for brokers. The second is that on all the settlements, that is, all the transactions go through the clearing houses of the exchange, which is again very good because there is no counterparty risk for investors. Settlement is very easy. And INR bonds has always been following the practice of enabling investors to only settle through the stock exchange, clearing house of the stock exchanges. The third regulations is regarding primary issues, and they believe that to make sure that the market is investors are not uh, misled by primary issuances that are downsold very fast from the time allotment to the underwriters or to proprietary books. They have said they have to hold it for 6 months. Now, there is a plus and minus point to this to be debatable. But most importantly is that this could give rise to a lot more of the debt IPOs, and where investors can invest as low as rupees 10,000 in the IPOs for fixed income, and this gives them that much more uh, variety of choices to invest in the fixed income markets. And the fourth is whether the listed and unlisted. So SEBI is saying that bond platforms need to only deal in listed bonds, that is listed on the stock exchange, and unlisted bonds. There are many unlisted bonds, especially most of the uh, subordinate debt are unlisted, and a lot of private bonds obviously are unlisted, but the information is not very high. So here, clearly, if there is enough information provided on a subordinated debt of a very good promoter, one of the top companies in India, then the information is there already. And here, so maybe there could be some delay. Again, there is still open for comments from the public, and is on the SEBI website. The investors are free to comment. And clearly, INR bonds has been following strictly the principle of education, information, and awareness of risk, along with a curated list of bonds through its app QuickInvest by INR bonds, which has seen good amount of traction by investors. And in the last 1.5 years since the platform has been launched, investors investing through the QuickInvest app have really done very well in comparison to the other products available in the market, given that interest rates have been rising very, very fast in the economy. So the bond platforms will be the way forward for all the players in the market, and in the global sense, a lot of the old practices where there was information arbitrage, low transparency in price discovery, prices, and transactions, and others will start to vanish, making the market more liquid, more accessible to a wide range of investors. More players will come in, more foreign participants, more Indians who have been denied access to corporate bond, and a very good way of saving with better returns against traditional products will be able to access corporate bonds. And all this will be done through platforms like INR bonds and others, and through like in equity platforms, through apps like QuickInvest, by INR bonds and other apps. Thank you very much for listening in. Do not forget to download our app, QuickInvest by INR bonds, and also subscribe to our YouTube channel if you've not done so already.